Namaste, and a very warm evening to everyone. A very warm welcome to today's session on Equity Market Insights by UTI Mutual Fund. I am Sonal Mittal, Product Specialist at UTI. The global investment landscape today is navigating a period of heightened uncertainty. Alongside shifting interest rate expectations and evolving growth dynamics across major economics, geopolitical tensions have once again come into sharp focus, particularly with the recent escalation of conflict involving Iran, US, and Israel in the Middle East. Such developments have significant implications for global markets. In fact, disruptions around the Strait of Hormuz, a key global oil transit route, have already pushed oil prices higher and added to the volatility across financial markets. To help us decode the current market landscape, we have with us Mr. Vetri Subramaniam, our MD and CEO, who will share his views on the global and domestic market outlook and how investors should think about markets in the current environment. We also have with us Mr. Vishal Chopra, who is fund manager for UTI Focused Fund, and he will be sharing his views and update us on the strategy, including portfolio approach and investment philosophy of UTI Focused Fund. With that, let me invite Vetri to begin the session. Welcome, Vetri.
Yeah, hi Sonal. Thank you so much and welcome to everybody who's joined us on this edition of the Market Insight for Equity, March 2026. As I always say, there is always something going on in the markets, and increasingly there is always some new topic which dominates the airwaves. And this time, actually, I think Sonal has put together a deck which covers many of these issues. So without wasting any other further time, I will ask Sonal to kick off today's discussion.
Sure. Vetri, let me begin with the global backdrop. The US rally has been driven by the MAG 7. What about EM performance? What does that mean for markets like India that currently have limited AI exposure?
Yeah, so that's a good question, Sonal. And, I think viewers should be able to see, what you have pulled up on the slide over here, which essentially gives you a perspective on AI in the context of emerging markets. So if you look at the slide on the left-hand side, it shows you within various markets in the Asia-Pac region, as well as within emerging markets, what percentage of the stocks could potentially be identified as beneficiaries of AI. So in markets like Taiwan, that's as high as 80%. In markets like China and Korea, that's about 32 to 40%. In the EM and APAC index, it's about 23%. And then, of course, as you come down that list, and let's say by the time you get to Saudi Arabia, it's down to 0.4. And you can see India, it's almost, marginal, and therefore, which is why there is no number mentioned over there. So essentially, AI is the beneficiaries of the AI theme are very significantly present in EM, but not present in India. Now, how does this matter? If you look at the chart on the right-hand side, it starts with the base of Jan 2025, and you can see that the AI beneficiaries are up almost 100% from Jan 2025. And if you see the rest of the market, it is up about 30% from Jan 2025. So essentially, the AI-related stocks, the beneficiaries of AI-related investment have driven over 50% of the emerging market return by rising almost 85% from their base in Jan 2025. So in a nutshell, AI has been a big driver of global equity market performance in the last 15 to 18 months. In the US, we talk about the MAG 7, but even in the EM and APAC indices, almost a quarter of the benchmark is related to AI or beneficiaries of AI, and that has been a driver of market. In India, we have negligible AI exposure, and that has resulted in relatively muted market performance. But I would not point to AI as being the only reason for underperformance. Keep in mind that starting valuations for India vis-a-vis the rest of the world looked very different in 2025, with India being expensive compared to those markets. And remember that there are some markets which have done very well, including, for example, on the same sheet, if you look at markets like Poland or even something like a Brazil, which has very limited exposure to AI, but those markets have also been solid performers over the last 15 months. So while AI explains some degree of outperformance of EM stocks, it is not the only driver of EM performance. So that's the important point also that I would recommend, or rather, it's the important caveat that I would put, that AI is a driver, but there are other factors as well which have contributed to the outperformance of EM relative to India.
Sure, Betty, that's very helpful context. But alongside these market trends, investors are also closely watching evolving geopolitical environment, especially in the Middle East. So what impact will geopolitical tensions and oil price volatility have on the current global rate easing cycle?
Sure. So as you know, we have some charts on this. Yeah, I think we've got that up there now. So you can see over here, these are the expectations of policy from key central banks: the US Federal Reserve, Bank of England, ECB, Bank of China. And you can see that in the last, sort of effectively 3 to 4 weeks, all those trend lines are spiking higher, which is to mean that there is the expectation of rate cuts has significantly reduced. So in the case of US, if you were looking at somewhere between 2 to 3 rate cuts, that probability is now showing less than 2 rate cuts. So effectively across the world, there has been a reduction in the expectation of rate cuts, because the primary assumption is that oil prices are moving higher. Because they have moved higher, inflation numbers will move higher, and that will constrain the ability of central banks to actually cut rates. So in a nutshell, expectations for rate cuts, Sonal, have reduced.
Sure, Vetri. So how persistent are the oil price hikes after geopolitical shocks? Are markets overreacting to the current oil spike, and what are the key risks?
Sure. We can see this on the next slide. And I would say the reality is that most military conflicts, and you can see a whole list of them: the Second Gulf War, the Venezuelan oil strike in 2002, the Arab Spring, then the Iran-Iraq War of 1980, the Gulf War of 1990, Russian invasion of Ukraine 2022. So all we have looked at what is the kind of price spike which has happened in all these cases. And you can see that in most cases, oil prices spiked anywhere between 30 to 50% at different points of time. So on average, the spikes are more than 40% at most points of time. And in the current spike, of course, over here we are showing up 20%. But actually, if you look at the spike level of crude prices, which were closer to 65, and with current prices being 100, I would say as on date, the extent of the spike is almost reaching close to 40 to 50%. But in most cases, as you can see on the right hand side, the prices then eventually give back their gains over the next 4 to 5 months in most cases. Only in one case, which is the Second Gulf War, after collapsing, it then continued to move higher. But I think the reason for that is that, remember, at that point of time, the whole global economy was going through a upturn. So broadly speaking, there is always a spike, but typically within 4 to 5 months, oil prices sort of retreat back to where they used to be. Will the same happen this time? Remember that the Persian Gulf accounts for almost about 20% of global oil supplies, and literally no tanker has been sailing through that region in the last 15-20 days. And therefore, as a result of that, there is a very significant supply disruption which the world is experiencing. But if the war does not go on for very long, then history might well repeat itself. And in 4 to 5 months' time, you might find that prices actually correct back to where they were. If, however, the conflict goes on for longer, then this pattern that you see over here may or may not necessarily play out. But the main point that I would make at this point of time is that the size of disruption is significant, and secondly, the period for which this remains ongoing is currently unknown, and those are the two risks that we are currently experiencing today. We can also look at the next slide, which I think provides another context. See, what you must remember in all these cases is that correlation is not equal to causation. So what you saw on the last slide is in most cases there was a spike of 40 to 50%, but then of course the oil prices retreated. What could make this time different? Here of course we are looking at the valuations of the S&P 500 on a 12-month forward basis. You can see in most previous spikes, actually, equity prices were much lower in terms of valuation. When a market is cheap in terms of valuation, its ability to absorb shocks is so much more, and if particularly the issues get resolved in short time, then the market is able to stabilize. But today we have one of the highest starting points in terms of valuation relative to the previous incidents of oil price shocks, and therefore, at least from a US context, this point of time the higher valuations remain a key market risk because the starting valuations are so much higher. So essentially, I would sum this up in 2 points, Sonal. One, in most cases, there is a spike in crude prices, but that is given back within 4 to 5 months. However, correlation is not causation. We need to understand what the initial conditions look like from a valuation perspective. Over there, the news is not very comforting because starting valuations are slightly richer at this point of time.
Thanks, Vetri. Bringing the discussion closer home to India, how resilient is India to a spike in crude oil prices today?
Sure. Very good question. I know in most cases we always discuss this issue because the reality is that India is very dependent on imported crude to meet its oil requirement, because simply put, India is not self-sufficient either in crude oil or in natural gas to meet its requirements. So therefore, we end up importing these two. It's a significant part of our bill. However, what has happened in recent years is that India's services exports have grown to becoming much higher than our oil imports. So if you look at the left-hand side chart, the blue line shows you India's oil imports in dollars, and the black line is India's IT exports. And you can see that for many years, the blue line used to be above that black line. Then again, in 2022, when crude prices spiked up, the blue line temporarily went above the black line. But today, it remains significantly below. Of course, this assumes that FY27 crude prices remain at $80 a barrel, higher than the pre-conflict level, but lower than where they are today. So this is what has actually changed in terms of India's ability to absorb a crude oil price spike, which is that today we have enough exports which give us some kind of safety against these kind of spikes. The other sort of point I think which is important to look at in this environment is that even if the crude oil prices were to average closer to $90 per barrel, what you see on the right hand side chart is that India's current account deficit would remain about 2% or lower. And remember, RBI has typically articulated 2% current account deficit as being within its comfort zone. So, that is something which means that, up to $90 a barrel is something that we would not worry about too much on a macro stability issue. Of course, this would create some issues on the fiscal account, particularly if the government does not increase fuel prices. And secondly, this would also have an impact on inflation, both direct and indirect impact. And every $10 increase in crude prices as compared to the base level approximately adds about potentially 50 basis points to CPI inflation. The good news is that CPI is well within the comfort zone, and in the short term, the RBI does tend to look through the initial impact of crude on inflation. But I would essentially sum this up to say that today India is much better placed to absorb shocks in terms of crude oil price hikes as compared to what it used to be earlier.
Thanks, Vetri. Since monsoon is approaching, if 2026 turns out to be an El Nino year, could it pose risk to India's monsoon and rural economy?
Sure. So it's quite interesting this time, Sonal, even before I talk about this slide, just look at all the things that we've already spoken about today, right? We've spoken about AI, how India is not present in AI, how AI has been a driver of stock market returns. We've talked about how this geopolitical impact could impact the outlook for central bank easing. We have talked about how oil price spikes play out in the short term due to war and disruption, how they tend to mean revert if supply comes back and conflict ends quickly. We've talked about starting valuations. We have talked about India's ability to manage crude oil price shocks. And now we are talking about the monsoon. This, confirms one of my views that when you look at macro, there are so many things that can be discussed that there will always be some concern. If there is no concern, I always joke that market will invent a concern that you would then have to think about. But now we are talking about monsoon. The El Nino is a weather pattern which in the past has been associated with a lower than average monsoon in India because of the impact of the El Nino. And you can see that over here we have highlighted some of the El Nino years. And you can see over here that in the El Nino years, what happens is that agricultural GVA tends to do poorly, and as a result of that, aggregate GDP growth also tends to suffer because poor monsoon correlates into weaker agricultural output. Weaker agricultural output means lesser incomes for farmers. Sometimes it also ends up creating fiscal pressures which fall on the government, and therefore, as a result of that, it also pressures GDP. So yes, there is some risk from El Nino to the agricultural economy, but to the extent that the agriculture economy as a percentage of the Indian economy is closer to 15-16%, it's a concern, but it doesn't dramatically alter the perception of growth. But we'll see, because this is a moving target now that we are having to deal with so many risks and so many geopolitical issues all at once.
Sure. So while we are aware of the broader indices performance, how has the breadth stock level performance been within the universe? Mid caps are now outperforming large caps. Does this mean market is shifting towards growth oriented mid caps?
Good question, Sonal. First, just let's look at what's been happening in terms of the median CAGR return over a 2-year and a 3-year period. This is the data for the whole group of stocks. And what do the returns look like over a 2-year period and a 3-year period? I think this is for the Nifty 500 stocks. Now, the median return on a 2-year basis is just about 4%. The median return on a 3-year basis, still an extremely healthy number, I would submit, at almost 21%. What does it mean if the median return is 4%? It means that 50% of the stocks have returns which are less than 4% per annum, and 50% of the stocks have returns which are greater than 4% per annum on a 2-year basis. If you look at a 3-year basis, more than 50% of the stocks have delivered returns which are above 21%. And if you look at 50% of the universe, stocks have delivered a return which is less than 21%. So simple point is that 3-year CAGR returns still look good, but on a 2-year basis, returns are now far lower. And this reflects the starting valuations being expensive, and it also reflects some decline in market breadth, which is to say there are less stocks doing well and a larger number of stocks which are doing slightly poorly. But this doesn't capture the second question you had, which we can see on the next slide, Sonal. So on the next slide, we are talking about market performance based on capitalization. Nifty 500 TRI, Nifty 100 TRI, this sort of reflects the large cap part of the market, mid caps, and then small caps. And you can see the 1-year return, as you rightly pointed out, Sonal, mid caps on a 1-year basis are the best performing, large caps and small caps sort of similar, but on a 2-year basis, it's the mid caps which are the best, followed by large caps at about a 8.5% CAGR, and small caps at the bottom with about a less than 4% 4% CAGR. So what does this data tell you? Mid caps are obviously the best performing over a 1 year and 2 year period. Having said that, while we'll talk about valuations later, to me, this actually remains a little bit of a concern because valuations in mid caps still remain at a premium to the Nifty. Even in the small cap, valuations are slightly higher, but clearly now we are seeing a trend where small caps, at least over 2 years, are now underperforming the large caps. Now, very often at this time, people tell me, but how does market cap matter? It is only a reflection of market capitalization, not the fundamentals of the company. And once again, I would say that is a very good observation that those, persons would be making. But what we have seen over time is, what does it mean to be a large cap company? It essentially means in some ways you have better access to capital, you are better in many cases in terms of the quality of balance sheet, the debt on your books, and your ability to manage your cash flows. Very often it involves superior depth and breadth of management, as well as better capital allocation, sometimes because your governance structure in terms of the quality of the board is also superior. So once again, I would say the performance linkage is not just a question of the correlation because of market cap, but it's because of a function that, typically many of the larger companies tend to have far better depth of breadth of management. They have the advantages that I talked about in terms of their balance sheet, cash flow, and finally their board. So that's really the difference that actually we believe shows up in the longer term in terms of return outcomes, whereby we know that on a historical basis, mid caps have actually given the best risk adjusted return. The reason I would worry about that historical data today is that there is also a significant valuation premium that you're paying to large caps, which is not necessarily the case in the past. Secondly, historical data says risk adjusted returns on large caps is better than small caps. Today, given that small caps are at a valuation premium to large caps, once again, it gives me more relative comfort on large caps. But this is where we are just talking about the performance data of these set of stocks on a historical basis. Let's see what the future holds, and we'll talk more about that when we see the valuation section. Moving on from that, Sonal, I think we can move on to the next chart. I think this shows you the EPS CAGR. There's been some movement in these earnings estimates in the last few weeks. So the earnings expectations for March 27 are now more moderate at about 12% growth for the Nifty EPS, followed by 13% growth in March 2028. So there has been some cool off in the earnings growth expectations for March 27. I think a 12% earnings growth number is more reasonable given that nominal GDP growth is expected to be about, maybe 10% this year. So I would expect revenue profit growth for the broad aggregate to be more closely aligned with that, at least as a starting point. That would be the base case. So that 12% number looking far more within reach rather than mid to high teen number of 15 to 16%. And if you look at the next slide, this just shows you what recent trends have been. So we've just used a baseline number of 10%. So what we have looked at over here is, if you take the Nifty 500 companies, what percentage of the companies have greater than 10% year-on-year growth in terms of revenues, and what percentage of companies have greater than 10% year-on-year growth in terms of profits. If you go back to Q1 2024, you can see that 55 and 60% of the companies had more than 10% year-on-year growth. That number is now closer to about 50 to 52% in terms of the companies which have higher than 10% year-on-year growth. And remember, of course, on a sequential basis, there has been some improvement from the worst quarter, which was Q1 FY 2026. So the last two quarters have certainly shown some progression, which has been positive. But overall, I would still say that, that 12% earnings growth number that you saw on the previous slide seems to be more aligned with the kind of recent trends that we are seeing in terms of growth. And of course, 12% is the expectation now for March 27. I think we can just move on with that to the next slide, Sonal, where I think we're going to talk about valuations now. Yeah, so we're here on the valuation slide. So we're going to look at the same set of valuations first for the Nifty 50, followed by the mid cap index, and then followed by the small cap index. This is on the left hand side, the Nifty trailing PE. It's within that white zone. The white zone is the fairly valued zone. The yellow line is the average line. So yes, valuations on a trailing basis are above the average, but it is in the fair value zone. The forward PE multiple, which was actually in the expensive zone in the recent sell-off, has also now dipped into the fair value zone, above the average, but at least in the fair value zone. The next slide shows you the price to book multiple. This is now at 3 times, which is in line with the historical average. So not only is it in the fair value zone, it's in line with now the long-term average. The Nifty return on equity, which accelerated very sharply to above 16% from the base low in March 2020 to the high in 2024, is now dropped down to about 15%. This is as far as the Nifty 50 is concerned, which we could think about as being a benchmark for large cap stocks. What do valuations look like in the mid and small cap part of the market? That you can see on the next slide. And on the left hand side, you can see that the mid cap index is still trading at a premium on a price to book basis to the large cap. So 4.4 times price to book as compared to 3 times. So it's still in the expensive zone on a relative basis to large caps. Also, it is still at a premium relative to its own history in terms of valuations. For example, if you see March 18, or rather Jan, March, February 2018, by the way, at that point of time, midcaps went through a period of underperformance of almost about 2 to 3 years. Look at the peak at that point of time. It was below 4 times price to book. Today, even after selling off, it's still higher than that peak. And that is what gives me some sort of degree of discomfort as far as the Nifty mid-caps in aggregate is concerned. I'm not discussing individual stocks. I'm talking about a 150 company aggregate. That makes me uncomfortable. Similarly, on the right-hand side, you can see the Nifty small cap. Once again, look at the period 2018 to 2020, or for that matter, all the way to 2022. There was almost a 3 to 4 year period where small caps delivered negligible returns. During that period, the starting valuations were just higher than 2.5 or 2.6 times book, and then you earned negligible returns over the next 3 to 4 years. Right now, the valuations are at a significant premium to that level. Not only are they richer than large caps, which were at 3 times book, here, small caps are at 3.4 times book, but just look at the starting point of valuations as compared to where you were in Feb 2018 when you went through a period of poor returns. Now, obviously, that was one incidence. You have to look at multiple such incidences to understand probabilities, but I'm just using that as an example to tell you why is it that we as UTI Mutual Fund continue to remain slightly cautious on a top-down basis when it comes to mid-caps and small caps. When I talk to my fund managers, and you'll be listening to Vishal Chopra later, I think increasingly many of the fund managers tell me that when they look around within the universe of mid-cap and small-cap stocks, they are seeing some select opportunities, but top-down, as an asset allocator of picking large versus mid versus small, it is this valuations which still make us uncomfortable on a top-down asset allocator basis as regards mid-caps and small caps. Moving on to the next slide, I won't spend too much time on this, just to say that remember this line is still in that orange level where fixed income is more favorable, but the line has moved up because of the sell-off that's happened in equity. But it's only when it spikes into the green area that we would call it equity favorable. But we'll anyway look at our consolidated indicator, which comes subsequent to this. So this is the UTI Proprietary Equity Valuation Index. This is the index which our team uses to determine equity allocations in schemes like the UTI Multi-Asset Allocation Fund, the UTI Balanced Advantage Fund, and also in the UTI Equity Savings Fund. When you look at these strategies, this index, depending on whether it is in the orange, dark yellow, light yellow, green, or dark green regions, this drives our decision to increase or decrease equity allocation. Currently, of course, this consolidated indicator, which looks at price to earnings, it looks at price to book, it looks at dividend yield, and it looks at the indicator you saw on the previous slide, which is the comparison of P ratios and bond yields. So this composite indicator is in that yellow line, which suggests we are in the fair value for equity investing zone. What does this table convert into in terms of probabilities? You can see that on the next slide. So if, for example, you were to invest in the fair value for equity investing zone, that's the row in the middle, that yellow zone. So if you look at the data for almost the pretty much the last, sort of 20 years, 38% of the time the market has been in that yellow zone. The average 1 year return in those 258 observations is 12%. The best return, of course, has been 44%. The worst return has been minus 31%. 18% of the time you ended up with a negative return. 82% of the time you ended up with a positive return. 52% of the time you ended up with a 1 year return, which was better than 12%. So from a probabilistic point of view, that is why we believe this is fair value, because there is a 52% probability of getting a 1 year return better than 12%. Of course, there is some probability, 18% probability of landing up with a negative return of over a 1 year period. And remember, this indicator is only working on a 1 year basis, because this we use as a tactical, we use it rather as an asset allocation tool in the equity funds, which move between equity and fixed income. So it's only when the allocation, when the indicator moves into that orange zone or the dark green zone, is when the probabilities are very significantly either in favor of equity investors in dark green or against equity investors when you move into that orange zone. So today the market is in the middle, decent time, but continue to risk manage is the way I would describe it. So finally, just to move to our last slide, which gives you a summary of everything that I've been talking about today. Again, very seamlessly, we have moved from talking about things like tariffs to geopolitics, to oil security, and to the threat to jobs from AI. Remember, in India, not only do we have a lack of companies who benefit from AI spending trends or AI research trends, but also we are worried in India about the impact on the IT sector, which has been one of the fantastic creators of jobs in the white collar sector from this AI threat. So just look at the way threat perceptions have been moving so rapidly. The US-Israel-Iran conflict just adds to some of those macro concerns and uncertainty. The issue is not, has oil spiked 50%? We know that in the past this has happened. We looked at that chart. We also know that typically 4 to 5 months later, the system does tend to sort of rebalance itself. But at this point of time, we really don't know what the period of the shock could be and what the magnitude of the shock could be. We don't know about the degree of supply risk and the pressures that could emerge on the trade and current account. Also, expectations for rate cuts have now been backpedaled. Our equity in-house, as far as earnings are concerned, there is expected to be some improvement in 2027 as compared to the very poor years we had in 25 and 26. But again, uncertainty about the length and magnitude of the shock would most probably keep people slightly cautious. Our in-house equity valuation indicator is in the fair value equity zone. I already talked about that. And that is why we believe that in the current environment, asset allocation and risk management should remain priorities for investors. That's why we think, hybrid funds are something which should be considered rather than pure equity funds. Those who are looking for pure equity funds are biases towards large caps, because that is where relative valuation comfort lies. Finally, value has enjoyed when you think about market factors, right? We can talk about value, we can talk about quality, we can talk about growth, we can talk about low volatility, we can talk about momentum. These are some of the best known factors. There are many more. Value has enjoyed a significant cycle of outperformance over quality growth in the past 5 years. We've been very hopeful over the last 1 year for some, change in pattern. And in fact, in the first half of 2025, there were signs that a strong uptrend in quality growth was emerging. However, that has been disappointing when we finally see the outcomes over the last 1 year. But we remain believers in mean reversion because our past understanding of these cycles is that the cycles do mean revert, which means there are periods when you see strong performance from one indicator, but then it rotates to another. So we still think the odds favor, mean reversion in the days ahead. But I must admit it has been disappointing in terms of what we've experienced over the last year or year and a half when the mean reversion has not played out. But that's about it from my side in terms of painting the macro level picture. I'm going to halt over here and hand it back to Sonal, but she's going to be pulling back into the conversation Vishal Chopra. Vishal has been with us as an analyst for almost 15 years, both an engineer and a MBA. And he's, as an analyst, tracked multiple sectors at UTI. Predominantly in the consumer sector, but he's also looked at things like telecom and cement. So he's an old analyst, or I should say, old and wise, experienced analyst who's now gone on to manage money. He manages our UTI Focused Fund among the other funds that he manages, and that's the one he's going to be talking about today. And I think it's an interesting fund to talk about, just given the fact that his current portfolio bias is in favor of large caps relative to his benchmark. But I'll hand over to Vishal to take the conversation forward.
Thank you, Vetri. You really set the macro and micro market context very clearly. Let's welcome Vishal. Welcome to the webinar.
Thanks, Sonal, and thanks, Vetri, for the insightful presentation.
Great. So Vishal, my first question to you is, why should investors consider a focused strategy, a strategy which invests into 30 stocks, and what are the advantages does this strategy offer to the investors?
So if you look at it in the focus strategy, what we try to do is that we leverage our experienced research expertise and try to make a concentrated portfolio of high conviction bets from our research universe. And as you know, from a SEBI definition point of view, we can have maximum of 30 stocks in this portfolio. So in a sense, this is our 30 best ideas, high conviction best ideas, which leads to a concentrated portfolio. So obviously what it leads to is a portfolio of stocks where we think returns could be very good and it could generate very high alpha. But obviously with the concentration risk also comes higher volatility because the single stock position is higher. So what I would say is that if you look at any investor's portfolio of, in equity portfolio, obviously in the asset allocation, in the fund allocation he does, there'll be investment across large cap, mid cap, small cap. I think in that sense, focused category also finds a good place in an investor's portfolio, and that I think that portfolio should be looked as basically a portfolio which could generate high return with obviously higher volatility because of the concentration nature of the fund.
Sure, Vishal. Could you elaborate more on the investment style and strategy followed in this fund, particularly how you identify high conviction ideas and construct the portfolio?
Yeah. So one of the things which we keep in mind in this portfolio is that, as I mentioned, we already take a risk of concentration risk because we have less number of stocks. So on top of that, to reduce the volatility, we avoid taking any style risk. Style being either growth quality on one side and value on the other side. So what we have decided to do is that we run with this fund with a blend style. It's a blend of growth quality on one side and value. And how do we do that is that we try to, when we construct our portfolio, we typically try to identify ideas in 3 buckets of investment ideas. The core of the portfolio, which I would also say is the quality growth part of the portfolio, is which I called as sustainable businesses. These are typically companies which have a long sustainable runway for growth. Generally companies who generate very healthy return ratios, healthy cash flows, and most of these companies will have very high pricing power, or they are market leaders and they're gaining market share. They either have a cost advantage or they have certain network effects. So these are basically the quality growth part of the portfolio from a blend point of view. Now, to generate that additional alpha, we try to identify ideas in the cyclical opportunities part of the portfolio. And this can be in any sector. Mostly you will find this kind of opportunities in cyclical sectors like automobile, industrials, commodities, and some parts of obviously financial services which are more cyclical in nature. And these are companies which we believe are going through a cyclical downturn. Their valuations currently are at significantly discount to their where it should be. And when the cycle reverses, both profitability and valuations improve, which can lead to good alpha generation. And the third part of the portfolio, again, I would say is the alpha driver of the portfolio, is something which I called either you can call transformation or turnaround opportunities. Again, this kind of companies can be found in any sector, but typically they are companies who have been traditionally doing very well because of the reversal of the earlier factors. And if we believe the company can generate good alpha, we try to identify such companies and make part of the portfolio. So basically, we identify ideas across these three buckets, and these three buckets put together makes a blend of both quality, growth, and value. Now what I'll do is I'll just give you one example each of these buckets to just maybe drive home the point better. So if you go to the next slide, so this is an example of sustainable business, and this is a part of our current portfolio. So all the examples I'm citing are part of the portfolio. And Bajaj Finance, I know, I think everyone knows. And if you look at the left hand side, in last 11, 12 years, their AUM has grown by 13x, and while generating very steady ROA and ROE. And what this has led to a significant, meaningful return over last 10, 15 years. The stock has delivered very strong returns and obviously delivered alpha for our portfolio. If you go to the next slide. So this is next slide. Sorry, this is an example of cyclical company. Now, Tata Steel. So if you look at it, this is a typical commodity company in the steel business. Obviously, their margins are volatile, and which leads to obviously volatility in the stock price and the valuations. Now, if you look at it, what we have done on the left hand side, if you look at the profitability of Tata Steel's India business, and we plot the dotted line is the average profitability, and the blue line is the quarterly profitability. And when we added this stock in the portfolio, we saw that the current profitability is meaningfully below the average line. And on the right hand side, if you look at, these are the Chinese steel prices. Basically, steel prices generally globally are determined by what is happening to the steel prices, and on top of that we have duties in India, but primary driver is Chinese steel prices. And if you look at that chart, you will realize that Chinese steel prices are also meaningfully below average. So what we realize in this company is that both the profitability is below average, the global steel prices are also below average, and there's a significant, obviously probability. We thought that both the steel prices could go up in China, which could lead to obviously prices going up in India, leading to a better profitability. So because of that, we invested in this stock, and obviously from our investment, the stock has done well. Even the valuations have gone up, and cyclically we have made a good return in this stock. And last example I'd like to give of a turnaround company. This is a portfolio company. I mean, this is, as Vetri mentioned, I was also a telecom analyst, so I've looked at this company for more than 10 years now. This is a company we have held across many portfolios, including the Focused Fund. And I think story is also quite known, is that if you look at 2016, before Jio entered the telecom industry, Bharti was earning an average revenue per user of almost 200 rupees per month. Post Jio's entry and the disruptive price competition, that ARPU, which was 200 rupees, fell all the way up to almost 120, 125 rupees. And what that led to was that the EBITDA margin of the company, which was 40%, fell close to 20, 25%. And in that time period, we saw multiple companies shutting down in the telecom industry. Before Jio came in, we had 6 to 7 players in the industry, and now we are barely left with 3. And post that consolidation, since Jio was also not making money, you saw industry taking tariff hikes, and which led to the ARPU going up again from around bottom of 120, 125 rupees to almost 225 rupees today. And the EBITDA margins, which fell to 20, 25%, are now close to 50%. And the stock price, we very well know, I think the stock price was below 300 rupees, and the today's stock price is above 800 rupees. So it's been a good journey, and it has helped our portfolio. This is a typical turnaround company. In this case, the turnaround was led more by change in the competitive intensity. First, the higher competitive intensity led to a downturn, and once we realized that the competitive intensity has led to the consolidation and now it could improve, we thought it's the right time to look at this opportunity.
Yeah, thanks, Vishal. That was quite a lucid explanation of how you are managing this fund. In the current market environment, could you also explain what is the current portfolio looks like?
Yeah. So, I mean, this is just some data. I'll just highlight few things. If you look at the portfolio today, I mean, large cap is around 79% of the portfolio. I mean, just to keep in mind, this portfolio does not have any restriction in terms of market cap, but because we are more comfortable with large cap valuations today, which Vetri already explained in his slides, the portfolio is more tilted towards large cap. It has a high active share because given the concentration, we have a 65% active share. And if you look at the price to book of the portfolio, it's around 6.9, which is very close to the benchmark price to book of 6.84. So one of the ways to obviously judge whether the portfolio is managing a blend style is if you can just look at the price to book of the portfolio versus the benchmark. And the endeavor is to keep the price to book of the portfolio plus or minus 10% of the benchmark, because that's how it reflects the blend strategy of the portfolio. If you go to the next slide, you'll just see the on the left hand side, you see the top 15 holdings of the portfolio, and on the right hand side, you see the sectoral breakdown and the active share. Financial services is the largest sector in the portfolio, which is largely an equal weight. And obviously, we are bullish on that sector. And as we keep getting good opportunities at good valuation, we keep adding to that. The other large overweights are consumer durables is a large overweight. So we have been bullish on consumer discretionary in this portfolio, especially in the last 1 year when we have seen government focusing more on reviving consumption with income tax cuts, GST cuts. So we are positive on durables. We are not so positive on the FMCG part of the portfolio, I think, which is now witnessing quite low growth. So we are underweight on FMCG within the consumption space. Otherwise, we have marginal overweights on automobile and IT. Construction is one space where we are overweight because I think within the whole capex theme, construction valuations are still favorable. So we are overweight on construction while we are underweight on capital goods. So that's how I think it's a fairly balanced portfolio because we are managing a blend style, and that's how the portfolio is currently.
Sure. Another important aspect investors often look at is the market cap allocation within the strategy. How do you decide on the market cap weights for the fund? And what is your current view on the allocation between large cap, mid cap, and small cap?
Yeah, so currently we have 79% in large cap. And in this slide, you can see the more longer term trend. So when we launched this product, I think the mid cap and small cap valuations were far more favorable. So we had far higher weight in mid and small caps, but somewhere around from last 2-3 years, when we have gotten more and more comfortable with large cap valuations. In fact, if you saw this, if you just saw some time back, Vetri had shown in his slides how valuations of large cap are already at average, while mid and small cap it's still at +1 standard deviation. So we have continued to manage a tilt towards large cap. That is not to say that we will always be this way. It all depends on the valuation. As a overall, I think bucket mid and small cap valuations still look on the higher side versus large cap. So we have continued to have more weight in large caps. As that corrects, as mid and small cap valuations become more favorable, we can obviously increase our exposure to mid and small caps. But again, mid and small caps on an absolute basis have also seen correction. So obviously there are opportunities and there are companies specifically in mid and small cap which we may find attractive and which we look to add. But as a broad theme, we continue to prefer large caps more over mid and small caps. And if you look at the data, I think from December 22 till today, which is almost 3 year plus, our average large cap exposure has been 80%. And if you just compare the returns of the portfolio with, say, either Nifty 50 or either the large cap category average, the fund has outperformed both of them.
Sure. Thank you, Vishal. Now let's open the floor for question and answers from the audience. Vetri, my first question is for you. Given that Q3 for FY26 GDP growth was led by 13.3% rise in the manufacturing, do you see this high-speed manufacturing growth as sustainable, or is it likely to moderate due to this ongoing geopolitical tensions and rising oil prices?
Sonal, in my opinion, and having tried to analyze GDP data for many years, I've come to the conclusion that it is very hard to correlate these trends. Sometimes these are lagging trends, and sometimes they don't correlate with what we are able to see in corporate data. So I prefer to look at corporate level data. There is reasonable amount of momentum in manufacturing, but nothing which is exceptional at this point of time. So I don't necessarily read this data as some sign. Again, for the simple reason that GDP data is often lagging. B, GDP data goes through multiple revisions. First, they give you an early estimate, then they give you a first revised estimate, then a second revised estimate, then the final estimate. So, this is estimates keep getting revised way too frequently. Better to just look at corporate data and understand that corporate data is not giving us any strong signal either way.
Sure. Thanks, Vetri. Vishal, coming to you. Since focused fund run a concentrated portfolio, how do you ensure that portfolio concentration does not translate into unintended sector or factor risk? How do you decide position sizing and conviction levels?
So one of the ways, obviously, we are trying to reduce style risk or factor risk is by having a blend portfolio. And the other way, what we do, and is also an outcome of the intention to have a blend strategy, is also that we try to avoid taking disproportionate sectoral risk. So if you look at the sectoral allocation, it's not that we take, I mean, leaving aside one or two sectors, we try to avoid taking huge sectoral risk. Obviously, because it's a concentrated portfolio, stock specific risks will be higher. We can't avoid that. That's the nature of the product. But we avoid taking any significant style risk and we avoid taking any significant sectoral risk. That is how we try to reduce the uh, risk in the portfolio. On your second question on the conviction, so basically, if you look at the portfolio and the active weights in the portfolio, the active weights in the portfolio will reflect the return expectation we have from that stock. I mean, obviously, basis the risk associated with it. So wherever we find the best risk-adjusted return expectation, we try to have the highest conviction in that stock.
Sure, Vishal. Continuing on the same, how frequently do you refresh your portfolio and what typically triggers a change in holdings?
So there is no set time period, obviously, to refresh or change ideas. I mean, anytime we look into a new idea, we have an investment thesis on that. And if for whatever reason, after following and adding the stock in the portfolio and looking at it for multiple quarters, if the investment thesis is not playing out or investment thesis is actually getting vitiated, then obviously we look at the portfolio. We try to meet the company, understand the issues, and obviously take a call accordingly. So that is on the one side, how do we refresh the ideas? Second, on the other hand, there could be many times that the investment thesis has actually worked very well. The stock has given very strong returns, and now the valuations have become very expensive. So in that case, also we can either look to trim the position size because we think that the future returns could be now lower. So obviously the active weight in the portfolio of that stock needs to be revised. Or obviously, in many cases, if the valuations become very, very expensive, we might choose to exit if we find a better alternative opportunity. So those are the things we have in mind when we keep evaluating the portfolio on a continuous basis. I mean, not to say that every idea will be reviewed in a fixed frequent basis. I mean, there are ideas which we are holding for 5 years also could be, and there are ideas which could be holding for 1 year. So it depends on the investment thesis and the return potential we see in that idea.
Sure. Thanks, Vishal. Vetri, the market is currently building in healthy double-digit earnings growth expectations. Do you think the risk today lies more in the earnings disappointment or valuation compression?
I don't think it's possible to isolate that, Sonal. I would say it's always a combination of the two. Remember that I think over the last 3 months, we have already seen cuts to the FY27 earnings estimates. Secondly, keep in mind that valuation on price to book is at average, but on forward PE, trailing PE, it's actually slightly above average. The consolidated indicator is in fair value, but we know in the past it has gone even deep into that green value. So I would submit that there is scope both for earnings compression as well as for valuation compression, particularly when you think about the broader market. Because remember, our entire proprietary valuation indicator is only looking at the Nifty 50. It is not looking at the mid caps and the small caps. So when you put all of that together, then the picture that emerges to my mind would be slightly different. You may not be in fair value. You may be, maybe instead of being at the bottom end of fair value, maybe at the higher end of fair value, closer to the expensive zone. So that's the difference to keep in mind. So there is scope for valuation compression and there is scope for some earnings risk as well.
Sure. Thanks, Vetri. Vishal, coming to you. In the current market environment, many high quality businesses are trading at premium valuations. How do you balance the trade-off between paying up for quality versus maintaining valuation discipline?
I mean, I think so. I'll try to answer this differently. Is that a lot of times we look at the PE multiples of companies and come to a conclusion that this is, I mean, a 40 PE company is expensive and a 15 PE company is cheap. I think it's not such a simple exercise. So a lot of times a company which is trading at 40 PE but generating very high ROIC and generating very good free cash flows might be actually be cheaper than a company trading at 20 PE but actually highly leveraged and having poor ROC and poor free cash flow. So looking at the PE multiple and then judging is difficult. What we try to do continuously is that we try to understand what is the growth implied in the current stock price or in the current valuation. And if we think that the company has the potential, the execution capability to grow better than what is being implied in that current price or current valuation, we'll be comfortable holding to that stock. So that's how we try to look at it. We look at the valuation and have a balance between as I said, we look for different ideas. We look for cyclical ideas, we look for turnaround ideas, and we look for sustainable business ideas.
Sure, Vishal. Continuing with you only. Since focus funds can experience higher short-term volatility, how should investors think about risk and return expectations?
So, I mean, you rightly said that obviously this is a category where the concentration risk is higher because there's a 30 stock portfolio. So the return potential is higher. Obviously, along with that, volatility in the returns also could be higher. And I think one of the best ways to tackle that, and that's true for any diversified equity fund, not just for focused fund, is that I think one investor should come with a longer term horizon. And we have a lot of data or studies on that. If an investor comes and invests in a diversified equity fund with a 1 year time horizon, there's a decent probability that the returns could be negative. But as soon as you increase that time horizon to 5 years and plus, I think the probability of negative returns drops dramatically. In fact, it goes close to zero. So one of the ways to reduce that volatility is that to invest in this category with at least a 5 year plus horizon. Second, obviously, given the volatility, I think one of the best ways to again invest in this category would be through SIPs that will automatically reduce the volatility of the return and obviously will help you invest at all cycles in this portfolio.
Sure. Thanks, Vishal. Vetri, coming to you. The India continues to trade at a valuation premium to most emerging markets. In your view, how sustainable is the premium and what would need to happen for it to expand or compress?
Sure. That's an interesting question, and I wish it was as simple as having a mathematical formula that could tell you how to derive it. The reality is that you can't because it's a function of investor expectations. So it's easier to understand what is implied in the price rather than to say this is the right level. Of course, you have the history you can refer to. If you look at the history, you'll see that typically India has traded, I think, at about a 50% premium to the EM indices. It went up to as high as 100% a few years ago. But I think today we are back to about the historical level of about 50%. But if the average is 50%, it means there have been instances where the valuation has even gone at some point of time to equal to the EM. So I think we are back at the average. So that is a good sign in terms of the relative. But I would actually submit, to my mind, Sonal, I think the challenge over here is that is India's earnings growth outlook going to be at least 12% or higher? After 2 years of single digit earnings growth in India, and given all the macro, sort of shocks and uncertainties that we are still trying to price in, the question is, is all of that already captured in the price or not? And will India go back to that situation where its earnings growth remains at a premium to the rest of Asia? In the past, India's earnings growth was always much better than what the rest of Asia were to report. But that has not been the trend in the last 2 years. So I think, unfortunately, the answer is that it depends. And to my mind, that's a function of can you get better earnings growth in India, particularly relative to the rest of the world over the next 2 to 3 years.
Sure. Thanks, Vetri. Since we are coming closer to the end, one last question for you. If investors listening today remember just one principle about investing in equities over the long term, what would that be?
Oh, that's a very tough one. I mean, we have, considered so many geopolitical shocks. But I think eventually, to my mind, even though I may not have said this so far, I think the most important thing, Sonal, to just remember is that when we talk about the magic of compounding, when we invest, too much focus in that magic of compounding, and the magic of compounding is nothing but the compound interest formula. Too much of the focus is on R, which is the rate of return. Whereas when you look at very long periods, what you realize is that the benefit of compounding is actually driven by the N, which is the number of years that you remain invested. And these year-to-year fluctuations in terms of returns can be very, very significant. People don't remember today, but the crash that happened during COVID during the year was almost about 20-24%, though start of year to end of year, it didn't show up. Today, when you look at 20-year returns, they are still running at 12 to 14%. But people don't remember perhaps that when the GFC happened, a global financial crisis in 8 or 9, the market actually fell 50% for 1 year. Between 2008 and 2013, the market actually delivered net zero return. But when you stand back and look at the larger picture, which is the 20-year period, then you see the benefit of compounding at 12%. And therefore, to my mind, if I were to once again reiterate, it is that N which is the most powerful friend of the long-term investor. It is not the R.
Right. Very well said, Vetri. Thank you so much for your views. In fact, we have received some suggestions from our viewers on the funds that we can explore to add into our product basket. We appreciate your suggestions and we will evaluate the ideas. With this, we coming closer to the end of today's webinar. There will always be some news and some noise in the markets. Staying focused, disciplined, and let the compounding do its magic remains the key to wealth creation. Thank you all for joining us this evening and for your engaging participation. We truly appreciate your time and look forward to continuing the dialogue in the next month's webinar. Until then, stay invested and stay disciplined. Good evening and thank you once again.
Thank you, Sonal.
Thank
Thank
you.
you, Vishal. Thank you, everybody.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.